Hello traders, you're welcome to this video. In this video, we are going to be discussing how to trade candlestick wicks effectively. Okay, so basically trading candlestick wicks can be a powerful way to spot reversals and optimize your trade entries and exits. So we're just going to be looking at a step-by-step breakdown on how you can understand how to trade wicks effectively. Okay, so the first step is to understand what a candlestick wick represents. Okay, the candlestick wicks, they are also called shadows. Okay, they show the high, as you can see, these long lines that project from the body of the candles. Okay, they are called the wicks. Okay, so they show the high and low points that price reach during a time period. This is the 4-hour time frame, for example. So it means within 4 hours, the wick shows the lowest point that the price reached and the highest point that the price reached within that time frame. A long wick often signals rejection of those price levels, indicating that either buyers or sellers took control. So in this situation where we had a long wick down, it showed that price got rejected and the buyers took control. That is the reason why they were able to push the price all the way up. The price opened around here and sellers initially gained some momentum. Although within 4 hours, sellers had some momentum. That's the reason why they carried price down to this point. But eventually, the buyers gained control and took the price back up all the way from here to this point. Okay, so long wicks that um usually show that either buyers or sellers took control or had strong momentum. Okay, so if you had long wick down, it shows that buyers had strong momentum. If you had long wick up, it shows that sellers had strong momentum. Okay, so the upper wick is called the long shadow on top. Okay, the upper wick is the upper shadow. Let me just put it that way. It indicates that the price moved up, but sellers pushed it back down before the close, like what happened here. Price moved up, but sellers pushed it back down before it closed. While the lower wick, it shows that price dropped, but buyers pushed it back up, showing buying strength. Okay, now the second step is to spot reliable wick patterns. Now there are some wick patterns that are more powerful at indicating reversals. Okay, here are some key patterns to watch for. Number one is pin bar. Okay, pin bar is also called hammer or inverse hammer. It is hammer in the case of bullish and inverse hammer in the case of bearish. Okay, so pin bar is a candlestick. Let's just check if we can see a pin bar somewhere. Pin bar is usually a candlestick that has a small body with a long lower or upper wick. If it is a hammer, it has a long lower wick. If it is an inverse hammer, it has a long upper wick. We can see a hammer here. The longer the wick compared to the body, the stronger the reversal. As you can see that we had a hammer here. It formed as a continuation pattern here because hammer forms either as bullish reversal or bullish continuation. Inverse hammer, which is just the opposite, the wicks are hanging on top and the body below. That one forms as either bearish continuation or bearish reversal. Okay, so we can see that after this hammer form, the price continued to go up, so it indicated a bearish continuation. Now another wick pattern that is important to note is the doji candlestick. Now the doji candlestick is a candlestick with little or no body. Yeah, in some cases you will literally not see any body. It will just be like a line, a horizontal line, something like this. This is an example of a doji. This one is just like a horizontal line and a vertical line. See another one here. This is also a doji. This is also a doji. This is a doji. This is a doji. A doji has either little body or no body at all. Okay. Now, but it has wicks on both ends. Yeah, at least the wicks should be lengthy enough, longer than the body. The wicks should be longer. If there is a body at all, the wicks should be longer than the body, and the body should be small. Okay, it can precede a reversal, especially if it happens at the end of a strong trend. Especially if it happens at the end of a strong trend. For example, let us see if we can find a doji happening at the end of a strong trend. Okay, now we can see that we had a doji here, and this was actually at the end of this strong trend, and we can see that right after the doji formed, you can see that price came down all the way to this point. Okay, now another pattern to spot is the engulfing pattern with wicks. Yes, there are engulfing pattern that has wicks. If you spot a candlestick with a long wick following a trend that gets engulfed by the next candle, okay, let us see if we can find such. If you spot a candlestick with a long wick following a trend that gets engulfed by the next candle, this can indicate strong momentum for reversal. Okay, let us see if we can find such example. Okay, this particular example might not be easy to come around, but basically I'm just going to just explain it, even if it does not show up, just in case if you later find it on your chart. So what it means is that, for example, let us just assume, okay, this is going to be based on assumption. Okay, let us just assume that this bearish candle engulfed this bullish candle. Remember that engulfing pattern, it is the body that should be covered. The wick does not necessarily have to be covered, it's the body. So had it been this red candle had swallowed up the body of this blue, it would have been a bearish engulfing. Okay, so the preceding candle has a long wick, and then the next candle engulfed the body of the preceding candle, so it shows strong momentum. Yes, such pattern might not always show up in the market, but when it shows up, it also shows strong momentum. Okay, now the third step we'll be looking at is looking for weak rejections at key levels of support and resistance. Okay, a long wick rejecting a support level means buyers are defending that level, while a wick rejecting a resistance level indicates strong selling pressure. So in this case, we would have to map out our support and resistance levels. Okay, we have to map them out so that we can be able to identify when a wick forms around a support or resistance level. Okay, so now we can see that we have a resistance around here, right? And then you can see that price got rejected about this point. We can see a long wick forming, so it shows that sellers were taking control around here because the wick indicates that sellers push the price from this rejection. Same thing happened here, and you can see that when that happens, there's chance that the price is going to reverse to the next support. That is for a sell, right? Okay, same thing happened here. Price reversed to the next support. Then in the case of a wick below, a wick bouncing off a support, chances are that price is going to get rejected and reverse to the next resistance. So we can see it happened here. Price got rejected and pushed to the next resistance. It happened here, pushed to the next resistance. So in such situation, if you want to trade that, you can decide to just enter after the candlestick forms. You can set your stop loss below the support for a buy, above the resistance for a sell. Target the next support or resistance for your take profit. Okay. So now, how do you combine? This is step 4 now. Combining wicks and price action. Remember that this strategy we are talking about is trading with candlestick wicks effectively. Okay. So the first thing you should consider is confluence with trends. So if you see a long wick after an extended trend, right? You see a long wick after an extended trend. Let's see, this is an example. We had quite a long wick around here, though not too long, but yeah, it was long enough compared to like some other wicks that we see around here. Okay, now it could be a sign of exhaustion, making it a potential reversal zone. Now we can see that it showed that the buyers were getting tired, right? And then the sellers took control, and after a little bit of a consolidation, we saw that price came down all the way to this point. Now we have a support zone around here, so price came and retested the support zone before the buyers gained momentum again. Okay, so this showed that there was bearish pressure. Okay, now next thing is make sure to consider the trend, the time frame, and other technical indicators when interpreting wicks. It's important that you also consider other technical indicators. For additional confirmation, you can use the moving averages, you can use stochastics, other momentum indicators, okay? And you can also use the volume indicator just for additional confirmation, right? Okay, and make sure that you consider the trend. Yeah, if you notice a long wick at the end of a trend, there's chance that the reversal is about to happen. If you notice a long candle within a trend after a pullback, it's possible that the continuation is going to happen, continuation of that trend. Okay, so now for long trades, you might want to look for long lower wick at support after a strong sell off. That's when you want to enter your buy trades. Okay, at a support, it is more effective when you find rejections at a support, long wicks. For example, we had a wick here at a support. This would have been a good opportunity to enter a buy, and then after that we set our stop loss right below, some pips below that support. Okay, perhaps we can just use, if there's any swing low near to that level, you can use that as a reference. If not, if there isn't, calculate some pips, use good risk to reward ratio, calculate some pips below, set your stop loss, target perhaps the next resistance for your take profit. Then as for short trades, look for resistance zone where price got rejected with a good wick formed. Okay, then you enter your sell, take profits some pips above the resistance. Take profits can be some pips above the resistance. We also had another support around here. You can see there was price rejection. And that's the thing. It's also very important that you don't leave out any support or resistance zone, because we can see that price got to this support but it didn't get to this particular support, and eventually price began to reverse. So when you are trading, especially in a ranging market, because from this period to this period, you can see that the market was ranging, right? Make sure you don't leave out any support or resistance zone. Yes, so just make sure you are using good risk management and proper risk reward ratio, so that you would be using appropriate lot sizes, and you would still uh you know you will carry out trades with calculated risks. Okay, all right. So now if we had entered the sell about here after the wick formed, just after the wick, perhaps about here, set stop loss just above the resistance, this could have been a good place for the take profit, the nearest support zone. Okay, so in summary, candlestick wicks provide critical insights into market sentiment and reversals. Combine wick patterns with key levels and broader price action to make more informed trading decisions. Okay, and also try to practice spotting these patterns in different market conditions in order to refine your timing for trade entries and exits. I hope you found this video insightful. Kindly like and subscribe for more trading insights. Thanks for watching and happy trading.